You are sitting there, looking at your screen, and you feel that familiar pit in your stomach. Your retirement fund, the one you have spent decades building, suddenly looks smaller than it did just last week. You are watching Bitcoin drop below $90,000 for the first time in months. And you are probably asking yourself the same questions everyone else is asking. Should I sell everything now to save what is left? Should I buy more and hope for a recovery? Or is this finally the big one that takes everything down to zero? I understand exactly how you feel because I have spent years studying these cycles. If you are holding Bitcoin right now and feeling that pressure in your chest every time the price updates, you need to hear this. Before we go any further, please hit the like button and subscribe to this channel. Your support helps this message reach other people who might be panicking right now. Also, please leave a comment below and let me know if you are holding through this crash or if you are looking for a way out. It is now February 26th, 2026, and the world of finance looks very different than it did just a few years ago. We now have massive institutions, pension funds, and major insurance companies holding Bitcoin. We have spot exchange-traded funds, or ETFs, that allow regular people to buy in through their retirement accounts. Many people thought that this institutional money would make the market stable. They thought that the days of massive 80% crashes were over. But here we are, watching hundreds of billions of dollars in market value evaporate in a matter of weeks. The truth is that every person who goes through a Bitcoin crash thinks their situation is unique. They think that this time is different because of the trade wars, or the Federal Reserve, or the latest global crisis. But I am here to tell you that it is never different. The numbers change, the names of the companies change, but the human psychology remains exactly the same. If you can understand the pattern behind these crashes, you can take back control of your emotions and your financial future. Let us start with the history, because the math does not lie. In June 2011, Bitcoin crashed 99% in a single day. It went from $32 to literally 1 penny. You might think that does not count because it was the early days, but it established the psychological playbook. In April 2013, it crashed 83%, falling from $260 to $54. In December 2017, Bitcoin peaked at nearly $20,000, only to lose 84% of its value over the next year. That was not a quick drop. It was a slow and soul-crushing decline that lasted 12 months. Even in 2021, we saw Bitcoin hit $64,000 in April and fall to $29,000 by July. And in 2022, we witnessed the collapse of major platforms that sent the price back down to $15,000. And now, here in 2026, we are seeing the same story play out again. Every single one of these crashes follows 3 specific phases. Once you see these phases, you will realize that what is happening right now is not a disaster. It is a process. Phase 1 is what I call euphoria multiplication. This is the moment when people who do not understand technology or finance suddenly start telling you to buy. In late 2025, when Bitcoin hit $126,000, everyone was a genius. You heard people saying that it was going to $1 million by Christmas. Your neighbors, your coworkers, and even people who have never invested a dollar in their lives were opening crypto accounts. This is driven by something called recency bias. Your brain begins to believe that because the price has been going up, it will keep going up forever. But the higher the price goes, the more fragile the market becomes. Phase 2 is the catalyst and the liquidation cascade. A catalyst is just an excuse for the market to do what it was already going to do. It might be a new regulation, a geopolitical conflict, or a major company selling its holdings. But the real reason the price drops so fast is because of leverage. In 2026, many traders are using borrowed money to buy more Bitcoin. When the price drops even a little bit, the exchanges automatically sell their Bitcoin to pay back the debt. This is called liquidation. In our current crash, we saw over $500 million in positions liquidated in a single day. When those positions are sold, it pushes the price down even further. This creates a domino effect that turns a small correction into a massive crash. Phase 3 is the most difficult part for retirees, and it is called the demoralization grind. After the initial big drop, the market does not just bounce back to the top. It stays low, it moves sideways, and it bounces up just enough to give you hope before dropping again. This is designed to break your spirit. It is during this phase that most people finally give up and sell at the very bottom. They hold through the drop from 120,000 to 90,000. They hold through 90,000 to 70,000. But when it hits 60,000 and the news says Bitcoin is dead, they finally sell. And that is usually exactly when the market begins to recover. As an investor looking toward retirement, you have a different set of rules than a 20-year-old trader. You do not have decades to wait for a recovery if you make a massive mistake. But you also have the wisdom to look at the long-term horizon. Something is legitimately different in 2026, and that is the role of institutional ETFs. For the first time, Bitcoin is now a part of the global macroeconomy. It trades based on what the Federal Reserve does with interest rates. It reacts to the strength of the United States dollar. This means Bitcoin is no longer just a digital experiment. It is a legitimate asset class. But with legitimacy comes a new kind of risk. We are seeing that institutional investors panic just as much as retail investors do. When the ETFs start seeing hundreds of millions of dollars in outflows, it puts pressure on the entire market. We also have to look at companies like MicroStrategy. They have borrowed billions of dollars to buy hundreds of thousands of Bitcoin. If the price drops below their average purchase price, it creates a massive psychological weight on the market. If the biggest believer in Bitcoin is forced to sell, what does that mean for the rest of us? This is why narratives are so important. Investing is not just about math. It is about the stories we tell ourselves. When the story is that Bitcoin is the future of money, the price goes up. When the story breaks, the price collapses. But here is the truth that history has taught us every single time. Bitcoin has survived every 90% crash, every hack, and every government ban. The network itself does not care about the price on your screen. It keeps producing blocks every 10 minutes, exactly as it was designed to do. Now, let us talk about the specific dangers facing retirees in this 2026 environment. Many people in their 60s have recently moved their retirement funds from traditional bonds into Bitcoin ETFs. They did this because they were worried about the rising cost of living and the devaluation of the dollar. While that logic is sound, the timing has been brutal for many of you. If you are looking at your portfolio today and seeing a sea of red, your natural instinct is to run for safety. But in the world of high finance, safety is often an illusion that costs you a fortune. The financial industry is built on taking money from the impatient and giving it to the patient. Wall Street loves it when you panic sell your ETF shares at $80,000 because they are the ones standing on the other side of that trade, waiting to buy your assets at a massive discount. They have what is called a long time horizon, meaning they can afford to wait 5 or 10 years. As a retiree, you might feel like you do not have that kind of time. But let us be realistic about the numbers. If you are 65 today, you might easily live another 20 or 30 years. That is a long time to remain invested. If you panic sell now, you are effectively locking in a loss that can never be recovered. You are guaranteeing that you will have less money for the rest of your life. This is what I call the ultimate retiree trap. You sell to avoid a further drop, but then you miss the inevitable recovery that follows. By the time you feel safe enough to buy back in, the price is often higher than where you sold it. This cycle of buying high and selling low is how retirement dreams are destroyed. So, what should you actually do right now with your portfolio? First, you need to identify which category you fall into. Category 1 is for those who bought recently at the top. If you bought near $120,000 and you are down 30%, you are likely in pain. You need to ask yourself if you truly believe in the long-term value of this asset. If the answer is yes, then selling now only guarantees your loss. If you can afford to wait 3 to 5 years, history suggests you will be fine. But if you need that money for rent or medical bills next month, you should not have invested it in Bitcoin to begin with. Category 2 is for those who bought years ago and are still in profit. You are watching your gains disappear. And that hurts too. The smart move for people in this category is to consider de-risking. You do not have to sell everything, but taking some profit allows you to sleep at night. If you take out your initial investment, you are playing with house money. That gives you the psychological strength to hold through the rest of the crash. Category 3 is for those who are on the sidelines with cash. You have been waiting for a discount, and you have one. But do not try to time the exact bottom. Nobody knows exactly where the bottom is. The best strategy is to use dollar cost averaging. Break your investment into smaller pieces and buy a little bit every week as the price stays low. This way, you benefit if the price goes lower, and you do not miss out if the price starts to recover. Let us explore the global macro situation that is unfolding in early 2026. The United States government debt has reached record levels, and interest payments on that debt are now a major part of the budget. The Federal Reserve is in a very difficult position. If they raise interest rates to fight inflation, they make the debt harder to pay. If they lower rates to save the economy, they risk causing another wave of inflation. In this environment, scarce assets like Bitcoin are seen as a hedge against currency debasement. The institutions like BlackRock and Fidelity did not buy Bitcoin because they wanted to gamble. They bought it because they see it as an insurance policy against the traditional financial system. When you see a price crash of 30%, it does not mean the insurance policy is broken. It means the market is searching for a fair price in a very uncertain world. Remember that Bitcoin is the first truly global 24/7 market in human history. It is a pure reflection of human fear and greed, amplified by high-speed trading algorithms. These algorithms are designed to trigger your emotions. They want to push the price down just far enough to make you give up. Once the last person sells in despair, the big players step in, and the price begins to move upward again. This is the cycle of capital, and it has been happening for centuries. From the South Sea bubble to the dot-com crash, the patterns are identical. The only thing that has changed is the speed and the technology. As a retiree, your greatest asset is not your money, it is your perspective. You have lived through high interest rates in the 80s. You have lived through the dot-com bust and the 2010 financial crisis. You know that the world does not end when the stock market drops. You know that quality assets eventually recover and reach new highs. Bitcoin is currently the best performing asset of the last decade, but it is also the most volatile. You cannot have the massive returns without the stomach-turning volatility. If you want the stability of a savings account, you have to accept the near zero returns of a savings account. But if you want to protect your purchasing power against inflation, you have to be willing to sit through these storms. The world is changing fast, and digital assets are becoming a permanent part of the landscape. Central banks around the world are developing their own digital currencies. The way we think about money is being redefined right before our eyes. In this new digital age, having exposure to the original and most secure network is a strategic move. But it must be done with wisdom and moderation. Never invest money that you cannot afford to lose, or that you will need in the next few years. Always maintain a diversified portfolio that includes cash, real estate, and traditional stocks. Bitcoin should be the spice in your financial meal, not the entire dish. If you have followed these rules, then a 30% drop is nothing more than a temporary inconvenience. It is an opportunity to practice patience and discipline. Take a deep breath and look at the big picture. The world is currently facing high inflation and massive government debt. In that environment, an asset with a fixed supply like Bitcoin becomes more attractive over time, not less. The current crash is just a transfer of wealth from people who are scared to people who are patient. Which one of those people do you want to be? I want you to think about your legacy and the reason you started investing in the first place. Was it to gamble? Or was it to build a bridge to a better future for your family? If it was to build a bridge, then do not burn that bridge just because the weather is bad today. The storm will pass, and the sun will come out again. The 4-year cycle may be changing or stretching, but the value of scarcity remains the same. As we move further into 2026, Keep an eye on the Federal Reserve and the global liquidity cycle. When the central banks start printing money again to save the economy, Bitcoin will likely be the first asset to react. Until then, focus on what you can control. Control your spending, focus on your health, and spend time with the people you love. Money is just a tool to help you enjoy your life. Do not let the tool become the master of your life. If you found this analysis helpful, please remember to subscribe to the channel and hit the notification bell. We are going through a difficult time in the market, but we are going through it together. Leave a comment and let me know what your plan is for the next few months. Are you holding, selling, or buying the dip? I read every comment and I appreciate your perspective. Thank you for trusting me with your time today. Stay patient, stay rational, and I will see you in the next video.